You've seen them, right? If you've ever even glanced at a financial chart, you've seen those little red and green bars that kind of look like candles. They're called Japanese candlesticks, and for, gosh, centuries, traders have believed they hold a secret language, a way to predict the market's next move. But is there any truth to it, or is it all just financial folklore? And that's really the million-dollar question, isn't it? Can these colorful little shapes actually tell us where prices are headed? Or are we just, seeing stories where there are only statistics? Let's get into it. All right, so before we can answer that, we've got to get on the same page. To get to the bottom of this, we first need to understand what we're even looking at. So what exactly is this supposed secret language? At its heart, a candlestick is just a super elegant way to see a battle between buyers and sellers. It takes 4 key pieces of info from a specific time period, let's just say a single day, and crams it all into one simple shape. You get the price it opened at, the highest point it hit, the lowest point it dropped to, and of course, where it finally closed. So each of these candles has its own anatomy. The thick part, that's called the body, and it shows you the range between the open and the close price. Those thin little lines sticking out, those are the shadows, and they show the full high and low for the day. And the color? Well, that just tells you which way things went. Green means the price closed higher than it opened. Red means it closed lower. Simple, right? But pretty powerful. Okay, so that's one candle. But where things get really interesting is when these individual candles start to cluster together. This is where the stories really start to pop. Traders look for these specific sequences or patterns that they believe are signals for what's about to happen. Now, these patterns basically break down into 2 main flavors. You've got your bullish patterns. These are seen as signs of hope, right? They show up after prices have been falling and suggest things might be turning around. And then you've got your bearish patterns, which pop up after a price rise and act as a warning that a downturn could be coming. Let's take a look at a classic bullish hero, the hammer. Just look at the shape. It tells a whole story in one glance. It says that sellers tried to tank the price. That's that long lower shadow. But by the end of the day, buyers came storming back and pushed the price all the way back up near the top. The folklore says this is a huge sign that the buyers are taking back control. Now, this is where it gets tricky and where context is literally everything. See this? The hanging man pattern looks exactly like the hammer, but its meaning is the complete opposite. And it's all because of where it shows up. When this shape appears at the peak of an uptrend, the story totally changes. That big sell-off during the day isn't a sign of strength anymore. It's a warning shot that the sellers are getting aggressive and the rally might be toast. And you gotta love the names, right? They sound like something out of an old epic poem. You've got 3 white soldiers marching up a chart, 3 black crows signaling doom, the hopeful morning star after a dark night. I mean, they're less like technical indicators and more like characters in a big market drama. Okay, so the stories are awesome. They're dramatic, they're compelling. But let's get real for a second. We have to ask the most important question of all. Beyond all the folklore and the cool names, do these patterns actually work? I mean, really, is there any actual proof that a hammer is more likely to be followed by a price rise than just any other random day on the chart? Or are we just tricking ourselves, imposing meaning where there isn't any? So to settle this, we have to swap our storyteller hats for lab coats. And lucky for us, a 2018 academic study did exactly that. They decided to put this old folklore to a proper scientific test. And this wasn't some small-time analysis. These researchers went big. They took 2 of the most popular patterns out there, the bullish hammer and its bearish twin, the shooting star, and put them under a statistical microscope. They didn't just look at a few years of data. Oh no. They crunched over 6 decades of daily prices for the S&P 500 to see if these patterns had any real predictive juice. But here's the absolute genius of this study. They knew that everything hinged on one simple question. What does success even mean? So they tested it 2 different ways. First, they asked if the candle's closing price actually marked the bottom, which is how a lot of traders see the signal. But then they tested a much stricter definition. Did the candle's absolute low price mark the true bottom? This little difference, as we're about to see, changed everything. So they crunched the numbers, all 60 years of them, and the data came back with a verdict. And honestly, it was pretty surprising, but also incredibly clear. And wow, what a difference a definition makes. Take a look at this. When they measured success using the closing price, the patterns were no better than a coin flip. Not statistically significant at all. But, and this is a huge but, When they measured success using the absolute high or low price of that candle, the results did a complete 180. The patterns suddenly became highly statistically significant predictors of a temporary top or bottom. Don't just take my word for it. Here's a direct quote from the people who ran the numbers. They said using the close price was, and I quote, no better than that of using a randomly chosen candle. But using the low of the hammer, it clearly outperformed. So the folklore had a tiny bit of truth to it, but only if you measured it in a very specific, very rigorous way.
Okay, so let's zoom out. What does this all mean when you put it all together? What's the final takeaway here from this showdown between market legends and cold, hard data?
It really comes down to this. The stories are cool, they're memorable, but the boring statistical details are what actually matter. The romantic story of a hammer saving the day just isn't the whole picture. The way you define that signal, the way you test it, completely changes the answer. So, at the end of the day, these candlestick patterns aren't some magic 8-ball for the stock market. They're a tool. And just like any tool, their real power doesn't come from the story you tell about them. It comes from a precise, disciplined, and statistical understanding of what they can do, and more importantly, what they can't. So, I'll leave you with this question to chew on. The next time you see one of these patterns taking shape on a chart, ask yourself, are you seeing a story unfold, a little piece of folklore? Or are you looking at a single data point, a probability that needs to be tested and understood? The answer just might make all the difference.